How do you know how much a share in Amazon is worth? How about one in AT&T? Or one in ExxonMobil for that matter? Unlike, for instance, a painting or a sculpture, the value of a stock market company is not in the eyes of the beholder. So, if you're one of those people who have always thought that the price of a stock doesn't matter as long as someone else is willing to pay more for it, think again. This greater fool theory, as it is referred to, can be a really expensive game to play, as the investing community collectively proved during the dot-com bubble, and also one that is totally unnecessary. Why? Because at its core, valuing a company is actually simple, and in this video, I'll show you how. This is a top 5 takeaway summary of The Little Book of Valuation, written by Aswath Damodaran. And this is The Swedish Investor, bringing you the best tips and tools to reach financial freedom through stock market investing. Takeaway number 1. 2 valuation approaches: relative and intrinsic value. Valuing a stock market company can be done using 2 major approaches: the relative and the intrinsic value approach. The relative value approach is based on a single premise. I told you this was simple, which is that everyone prefers to pay as little as possible for identical assets. The intrinsic approach is based on 2 major premises. Everyone prefers money today over money tomorrow, and everyone prefers a sure bet over a risky one. Some people may favor one method over the other one, but I think that both are useful, and there's no reason not to confirm your investment decisions using both of them. My own investing strategy consists of first using a relative approach to screen for companies, and later use an intrinsic approach to decide if the individual company is worthy of my money. With that said, let's dive deeper into both of these. Takeaway number 2. A quick guide to relative valuation. What would you prefer? Buying a house for $200,000 or buying the neighboring house for $300,000? Silly question perhaps, but this is the basis for relative valuation. You compare an asset with another one that is as similar as possible and simply pick the cheaper alternative. In the stock market, it is never as clear-cut as in this example, but the premise is still the same. There are 3 essential steps for relative valuations. 1. Find comparable assets. We must compare apples to apples and oranges to oranges. If we take the companies that I talked about in the beginning of this video, it's easier to find comparisons for AT&T and for ExxonMobil, while it's more difficult for Amazon. Walmart comes to mind, but their stores are physical and not online. Frankly, no one even comes close to the online sales of Amazon, who has about 50% of the total online retail market in the US. 2. Use a standardized variable. To be able to compare these companies with each other, we cannot just look at the prices of the businesses and pick the cheapest ones. We must scale the price to another variable. Scaling price to earnings by using the so-called price to earnings or PE multiple is a good place to start. 3. Adjust for differences. We're not quite there yet though. To pick Walmart over Amazon just because its PE is lower doesn't make much sense. Usually, a company trades at a lower multiple than another one because its earnings growth is expected to be lower in the future. While historical earnings growth isn't in any way a guarantee for growth in the future, it can be used as an approximation, and to find interesting prospects to dive deeper into. As we can see, Verizon and Royal Dutch Shell are both cheaper and have experienced a stronger growth in earnings than their peers, which makes them interesting cases for further analysis. In a relative valuation, we assume that the market is correct on average, but wrong on an individual company level. But it didn't make much sense to pick one of the dot-com companies in 1999 at a PE of 100 just because it seemed cheap relative to its competitors that had PEs of 200. Therefore, this assumption may be flawed, and relative valuations, in my opinion, should always be accompanied by intrinsic ones. Takeaway number 3. A quick guide to intrinsic valuation. What would you prefer? $10,000 today or $1,000 per year for the next 10 years? Alright, perfect. So then we have established our first principle. Everyone prefers money today over money tomorrow. There are plenty of reasons for this, but two of the more important ones are instant gratification and inflation. Now, think about this one. What would you prefer? I'll give you $1,000, or you'll have to flip a coin. Heads, you get $2,000. Tails, you get nothing at all. Excellent. Then we have established our second principle too. Everyone prefers a sure bet over a risky one. Combined, these two premises help us in understanding the most important variable in an intrinsic valuation, often referred to as a discounted cash flow analysis elsewhere, by the way, and that is the so-called discount rate. The discount rate determines how much less a future income is worth to you, and the rate should be higher the more uncertain you think that income is. If you use a 15% discount rate, you essentially say that $1,000 the next year is worth only $870 today. $1,000 in 3 years is worth only $658, and in 10 years it will be worth only $247. The discount rate could also be viewed as how much yearly return that you demand for that asset. Now, how do we apply this in the stock market? Well, first and foremost, we must remember what a share in a company is. A share in a company is a claim against a certain portion of the future earnings of the same company. For instance, if you hold one share in Amazon, you are entitled to 1 out of 504 millions of the future earnings of Amazon. To get a little bit technical, we are actually not interested in net income, but rather something like Warren Buffett's owner's earnings. If we could say with certainty what the owner's earnings would be from this day to infinity, and use our previously determined discount rate to translate the earnings into today's value, we could say what the equity in a company is truly worth. If we divide that with the number of shares outstanding, we could say what a single share is worth. If the price of the share is lower than the value that we came up with, we would buy the stock, and vice versa. Calculating anything from now to infinity sounds like a daunting task, so we usually only estimate the owner's earnings for the first 10 years or so, and then calculate something called a going concern value. The owner's earnings for the first 10 years, plus the going concern value, determines the total value of the company. Remember that you are not looking for a stock that you estimate is worth something like 10% more than the price. You want what Benjamin Graham referred to as a margin of safety here. Use the discount rate that you require for your investments, say 15%, and then make sure that your intrinsic value calculation is at least something like 40% undervalued. As you can see, calculating the intrinsic value of a stock is simple, but not easy. Estimating 10 years of owner's earnings involves a lot of assumptions. For instance, how fast will the revenue be able to grow during these years? How high profit margins can the company maintain? And how much capital expenses will be required to support this? Your results from this valuation technique will be no better than those underlying assumptions. Therefore, in takeaway number 5, I will give you some guidelines for 3 common situations. Takeaway number 4. Truths about valuations. Even a combination of a relative valuation and an intrinsic one comes with its flaws. By being aware of these flaws, you can improve your odds of picking the right stocks. All valuations are biased. Why did you estimate a 20% revenue growth per year for the next 10 years for Amazon and not 10%? Choices like these will have major impacts on the valuations that you make, and you want to be sure that you are as rational as possible in your assumptions. Chances are that you have at least one reason of being biased. Maybe you like the personality of Jeff Bezos. Maybe you already own stocks in the company. Or maybe a friend of yours is on the Amazon hype train. Beware of this and question your assumptions one more time if you know that you're at risk. Most valuations are wrong, unfortunately, but this shouldn't stop you, because relative and intrinsic valuations are the two best tools that we have, and all investors are facing the same uncertainty. Also, sometimes it doesn't matter if your valuation is off by, say, 30%, because the stock is so clearly undervalued anyways. As Benjamin Graham famously said, "It is quite possible to decide by inspection that a woman is old enough to vote without knowing her age, or that a man is heavier than he should be without knowing his exact weight." Less is sometimes more. Take the estimation of future revenue growth as an example. There are so many variables that could go into this, but you have to be careful not to include too many of them in your analysis. Focus on just a few of the most important ones, perhaps competition, quality of management, and the potential size of the market, and leave the other ones out. Including too many variables will often cause you to miss the forest for the trees. Takeaway number 5. Context matters. Growth, decline, and cyclicals. Depending on what type of company that you are dealing with, you'll have to adjust your relative and intrinsic analysis. For example, valuing Amazon as a growth company, AT&T as a company in decline, and ExxonMobil as a highly cyclical commodity company will present different difficulties. Amazon, the growth company. Determining how scalable the revenue growth is will be of major importance. As suggested before, it starts at evaluating competition, quality of management, and the size of the overall market. Future profit margins are another concern, and typically, they will increase as the company matures. Having margins scale from the current level and to that of an industry average over time is probably a good idea. Don't wait too long before putting the company into the stable growth used for the going concern value. A strong growth company will not be able to grow like it did previously. The sheer size of itself will be a problem, as will competition. AT&T, the company in decline. Beware large capital expenses. You don't want the company to throw good money after bad. As Warren Buffett says, "Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks." An interesting property of companies in decline is that the risk for bankruptcy increases a lot. In your valuations, you must take this into account. Determine a value for the company if it survives, together with a value of the company if it defaults, and attach probabilities to both of these outcomes. If the company defaults, it probably has a lot of assets that can be sold off. The balance sheet therefore becomes much more important for the valuation of a company in decline than, for instance, the growth company. ExxonMobil, the cyclical commodity company. For cyclical companies, results vary a lot over a normal business cycle. One of the most interesting properties that they have is that they often seem the most undervalued at the top of a market cycle, or at the top of commodity prices, and the most overvalued at the bottom. But in reality, just the opposite is true. For these companies, it becomes important to normalize earnings to be able to make fair comparisons and intrinsic valuations. For a commodity company, you can use the average price of the commodity of the past 10 years, for instance, to see how it impacts revenues and net earnings. For an industrial company, you can use the average profit margins over a whole business cycle. If you want to dig deeper into how you can determine the fair value of a stock market company, I've created a playlist of videos on that subject for you. Check it out. Cheers, guys!